Instead of fully committing to domestic production, corporations make vague promises about new factories and job creation while waiting out the uncertainty. This strategy shields them from risk but leaves the economy vulnerable to instability. Jeffrey Gundlach and Fed rate cuts. Jeffrey Gundlach, known as the Bond King, has issued stark warnings about the economy. He predicts the Federal Reserve will begin cutting interest rates in July, a move that historically signals an impending recession. Looking back at previous recessions, 2000, the Fed cut rates, and a recession followed. 2007, rate cuts preceded the financial crash. 2019, the Fed lowered rates, and soon after, COVID-19 triggered a brief but sharp downturn. When the Fed cuts rates, it's often a sign that the economy is already weakening. If history repeats itself, we could be on the brink of something serious, the risk of stagflation. A growing concern is stagflation, a situation where economic growth slows while inflation remains high. This happened in the 1970s, with inflation hitting 5.8%, then 11%, and eventually soaring to 14%. It wasn't until the Federal Reserve aggressively raised interest rates to nearly 20% that inflation was finally controlled, but at the cost of back-to-back recessions. With tariffs potentially driving up prices, while the Fed prepares to cut rates, the US may be setting the stage for another round of stagflation. The combination of rising costs and job losses could create a devastating economic environment. Whether tariffs are beneficial or harmful is still debated. However, many experts, including Federal Reserve officials, argue that they are inflationary, driving up prices, while the Fed is forced to ease economic pressure. If the Fed cuts rates while inflation persists, we could be looking at a perfect storm of economic challenges. Are we headed toward a major recession? Will housing prices, the stock market, and job security take a hit? Only time will tell, but the warning signs are everywhere. If you found this breakdown helpful, make sure to like this video and subscribe Profit Powerhouse for more in-depth analysis on the economy and financial markets. Stay informed, stay prepared, and we'll see you in the next one. Is the US economy teetering on the edge of a major recession? If so, what does that mean for home prices, stock markets, and unemployment? In this video, we'll dive deep into the economic shifts that are rattling the markets, starting with Trump's recent tariff policies and moving toward Warren Buffett's shocking predictions that echo the 2008 financial crisis. Stick around as we unpack the warning signs that could spell trouble ahead, market decline, and tariff impact. From February 19th to March 13th, in just 17 trading days, the S&P 500 plummeted 10%, officially marking a correction for the first time since 2022. A decline this rapid suggests that the market is bracing for something much worse. Many analysts now believe this could be the beginning of a significant economic downturn. The uncertainty started on November 25, 2024, when Trump won re-election and announced a 25% tariff on imports from Canada and Mexico, along with a 10% tariff on Chinese imports. The stock market, which had surged 74% since 2020 and an astounding 181% since 2016, suddenly hit turbulence. For 15 years, the US had avoided a major economic collapse, and unemployment remained at record lows. But with these tariff policies, everything started to change. By mid-December, international governments, including Mexico, China, and Canada, began hinting at retaliatory measures. The markets, sensing the escalation of a trade war, started slipping. Then, on January 29, 2025, Trump officially signed the tariff orders into law, causing further instability. A brief 30-day pause on February 3 provided temporary relief, but by March 5, the tariffs resumed and the markets reacted accordingly. Mexico was given another temporary pause, but Canada and China faced steep import duties. Warren Buffett's warning and market shift. Warren Buffett has long championed investing in American businesses. Yet, in a surprising move, Berkshire Hathaway is now sitting on record cash reserves while increasing investments in Japan. This suggests Buffett is preparing for economic turbulence in the US. For those watching the fine art market, another trend is emerging. Even as the S&P 500 slid into correction territory, high-value art auctions continued thriving. With a projected valuation increase from $2.2 trillion in 2023 to nearly $9 trillion next year, alternative asset classes like art are attracting investors looking for stability. Pretend and delay. The corporate strategy, major reason many analysts foresee a recession, is a strategy among corporations called pretend and delay. Companies are hesitant to make long-term investments in U.S. manufacturing because tariffs can be reversed with a single political decision. For example, if Apple moved iPhone production to the U.S., manufacturing costs would skyrocket, making their products less competitive. Tariffs artificially level the playing field, but companies know they could disappear overnight with a political shift.